Hello, very good afternoon to all and happy Friday. Very good afternoon. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Today will be Friday, the 28th of February 2025 and also the month end. So before we start today's very interesting Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so very interesting movement across the major cross asset classes yesterday, but that also came in within our expectation for those who follow our daily dose of market insights. So still recall that we flipped to a bearish bias on the major US stock indices that we cover on the daily basis. The Dow Jones Industrial Average, which is the US Wall Street 30, can't break above the 50-day moving average, tested it on the first hour of the start of yesterday's official US cash trading session before it plunges down towards the end of the US session. The worst hit was the Nasdaq 100, later explain to you why, and also dollar strength starts to come back into the picture, but not so much on the dollar yen, which I already explained why, because of the divergence of difference in monetary policy and fundamental in Japan versus US. And as well that gold also start to see a bit of what you call it, large speculator late long net long unwinding, so we may start to see a corrective pullback in gold price as we are actually speaking for today. So yesterday gold actually plummeted below 2,880 slightly, and before it starts to consolidate towards the end of the US session. And West Texas crude oil managed to stage a slight rebound. Okay, later I'll touch on the technical outlook on West Texas crude oil. So the thing about this, why yesterday we start to see a risk off in the major US stock indices, is because tariff man is back again. So Trump himself actually said that he will go ahead, because time is running short, to ignite the 25% tariff on Canada and Mexico. So still recall that at the start of this month, this 25% tariff was actually give a cooling period for room for negotiation. So this cooling period is ending soon on next Tuesday, which is on the 4th of March. And Trump yesterday personally he said that he will actually impose 25%. So that's about what the weekend more to negotiate. So perhaps things may get very volatile. We know that Trump himself like to create a bit of element of surprise in the markets himself due to his way of doing things. And what's interesting over here is that he also added new China duties. So we call that the China tariff of additional 10% is being imposed since the start of this month. And right now, he said that additional 10% tariff on China to take effect next week. So that also causes the near-jerk reaction on the China proxy stock market play, which is the Hang Seng indices. So all the Hang Seng indices actually plummeted. The HSI plummeted by negative 2.6%. The worst hit was the high beta tech focus index, which is the Hang Seng Tech, is down by negative 4.4%, and the HSCEI, which comprises of China stocks listed in Hong Kong, down by negative 2.87%. And the mainland China benchmark index, which is the CSI 300, that actually saw a lesser magnitude of decline, negative 0.77%, because that is not really a international investor or trader play. So international traders will tend to look at the Hang Seng indices as a much more liquidity to actually trade in terms of news flow or narrative pertaining to global macro that could impact the Chinese economy. And also we see across the board in Nikkei 225 as well, which is down by negative 3%. So basically in the entire of Asia stock market, ranging from Thailand, Australia, Kospi, Taiwan, and even Singapore, all of them are down in the red. And precisely what you could see over here is because of the return of dollar strength. So like I mentioned earlier on, the dollar has been pretty much strong against the commodities related currency, which we came in within our expectations. They recall that for the Aussie dollar, I did mention that the Aussie dollar faced a significant bearish reaction of the 64 figure level. Once it can break above the 64 figure level, we start to see this kind of bullishness on the dollar against the Aussie. So what you could see over here is that these three of them are moving in tandem: the dollar CAD, the dollar Aussie followed by the dollar Kiwi. Bear in mind this particular chart over here, what I plot is a very short-term trend, a 5-day rolling performance of the US dollar against other major currency. That means I use dollar as the base currency. I want to stress that. That means $1 equals to how many Aussie, $1 equals to how many euro. That means if we start to see all these lines turning up, it means that dollar strength is prevalent in that particular pair. So I could see over here that these three of them are moving in tandem because all of them are related to one another. The CAD and the Aussie is considered as a commodities proxy. The Kiwi, not really a commodity proxy, but move hand in hand with the Aussie dollar. So that's why we start to see this very strong dollar strength in these three currency against the CAD because of the incoming trade tariffs that US wants to impose on Canada, and as well as it has a negative feedback loop into the Aussie dollar, then the Aussie dollar create a negative feedback loop into the Kiwi dollar. And what's interesting over here is that the nuggets over here that is not showing much dollar strength is against the dollar yen and the dollar Swiss. So both the dollar yen and the dollar Swiss, the Japanese yen and the Swiss are considered as a kind of a safe haven currency. So as we start to see this kind of systematic risk-off situation in global markets, the yen and the Swiss tend to get bidden up, or they tend to actually we call it have a slower pace of decline versus the US dollar. So that actually explain the not so much of a outperformance of the dollar against the yen and against the Swiss franc itself. All right, over here. And what we could see over here is that what's interesting is that this dollar strength that started this bounce among the commodities currency has managed to stage also a bounce of a key support level on the US dollar index, which I mentioned earlier at the start of this week daily dose, which is the 105.50 level that managed to see kind of a V-shaped recovery and also close to the 200-day moving average as well. All right, so this 105.50 level is in fact this former triangle-like range configuration that has taken shape since 17th of July, broken out in 12th of November after the outcome of the US presidential election, retest it on the 9th of December, and now managed to also retest close slightly and stage this V-shaped recovery. And if today we can start to see a daily close above this 20-day moving average that acted as intermediate resistance since the breakdown on 20th of January, there could be a chance that this particular down move since the high of 13th of January all down to towards the low of this Monday could be potentially a bearish flag formation within a medium term and major uptrend phase. That means a breakout above the 20-day moving average indicate a bullish breakout of this bullish flag formation of the US dollar index. That means i.e. potentially seeing significant dollar strength coming back into the FX market. And the potential catalyst that could actually kickstart this potential significant dollar strength coming back into the FX market is upcoming US PCE data that will be released in today's session as well. So later I'll touch about that more about this data later on, where I cover towards the end of today's daily dose and what is the time of the release of this data. All right, so back to the stock market over here. So I could see the US major stock indices. The worst hit was the high beta technology AI centric Nasdaq 100 that is heavily weighted in the Nasdaq 100, down by close to negative 3%, precisely negative 2.75%. The SPX down negative 1.6%. The Russell down negative 1.59%. The Dow Jones Industrial Average outperformed, but managed to still lose by a loss of negative 0.45%. And the reason why Nasdaq is the worst hit, if you look at the heat map of the S&P 500, we see a deep sea of red, especially in the semiconductor space, which is NVIDIA is down by negative 8.5%. So market is now looking for a risk that NVIDIA, there may be some tit for tat measures, especially being deployed on China towards US semiconductor and tech related company. And Google is down as well by negative 2.57%, followed by Metal down by negative 2.9%. So in fact, NVIDIA is so huge in the Nasdaq 100 weightage, it causes the Nasdaq 100 on the daily chart to break down below a key support level, increasing the risk of the start of a potential multi-week corrective decline phase in the major US stock indices. So despite the fact that the Dow Jones industry is holding well, maybe the Dow Jones also may not be able to shape a start of a bullish impulsive up move unless the Nasdaq 100 complete this potential ongoing medium-term corrective decline that was triggered off yesterday. And why the Dow Jones managed to actually shed a lesser decline yesterday? Because it's heavily weighted in the healthcare and the financials. So you could see we see a couple of greens in the financials yesterday, and the biggest component stock in the Dow Jones Industrial Average is this particular green box here, United Healthcare or Healthcare. UNH ticker code is up by 1%, okay, 1.07%. All right, so what you could see over here is a high beta sell-off in first step, and it is high beta component stocks, especially the semiconductor, are unable to actually stop the bidding. It could solely create a negative feedback loop into the entire stock market. And this has been also being surveyed by a latest survey that is being conducted by this prominent Harris poll. So this Harris poll did a survey on American consumer regarding about this current trade tariffs plan that Trump has on the rest of the world. And most of the components say that most of the correspondents say that will rise the cost of everyday goods by close to about 60%. So with such, we call it a pessimistic view about Trump tariffs towards the US economy, that could also translate down to weaker consumer confidence down the road, and weaker consumer confidence will lead to lower retail spending, actual retail spending. And we know that the services activity or the services sector contribute to 3/4 of US economic growth. And if this scenario continues to materialize, that means consumer correspondents continue to believe, or American consumer continue to believe, that Trump tariffs does more harm than good in general to the US economy, their confidence will continue to deteriorate. Deterioration in confidence will lead to a slowdown in retail sales. Slowdown in retail sales will lead to a slowdown in US economic growth. Eventually, you will start to see a slowdown in earnings growth as well in the US listed firms. So that could actually have a knockout effect on the major US stock indices that has performed the best in the world in the last 2 years. So there could be some kind of rotation play out of this kind of over optimistic earnings that has been priced into the US stock market at the start of this year versus other laggards like China, for example, and even some of the Southeast Asia major stock indices like Singapore. So yes, that's sum up the news flow and the related movement across the various cross asset classes that I want to share with you guys. So with that now, let us now jump straight into the short-term intraday technical outlook on the broad-based cross asset classes, starting from the FX market. So as usual, let me expand my screen so that you guys could have a better view on the charts that I'm going to share with you guys. So right now, let us start with the euro dollar first. All right. So for the euro dollar, it plummeted as expected. Can't break above the 1.0530 pivotal resistance that we highlighted since the start of this week. So what we could see this euro dollar since the low of 13th of January 2025, it has been trading in this kind of ascending triangle-like range configuration, a minor one, whipsawing across the between the 20 and the 50-day moving average. So what you could see right now is it hit all the way down to our support level that we highlighted yesterday, which is the 50-day moving average at 1.0360, ahead of today's price sensitive, potentially price sensitive core PCE price data. They're going to be released later during this, before the start of the US session. I'll touch more about that. So back at this 50-day moving average support, RSI start to shape a bullish divergence. There's a bullish divergence on the hourly RSI over here. So potentially what we could see over here is that there could be some form of a snapback rally either before or after the release of the core PCE price data. Resistance level to watch out for. First resistance level will be 1.0420 level, which is a 20-day moving average, acting as a significant, acting as the next near-term resistance. The key pivotal resistance zone will be the breakdown of this level here. Yesterday's steep breakdown now turns into a significant pullback support zone, 1.0440/45. All right, let me put it in better writing. Okay, 1.440/450. Okay, and if I do the Fibo retracement of this entire slide from the triangle range top all the way down to today's early Asia session low, is close to the 50% Fibo retracement. So as long as the bounce didn't surpass above 1.04550 over here, any signs of a bearish reversal candlestick likely to be exposed USPC price data release could potentially see another round of potential intraday bearish buyers coming in on the euro dollar. A breakdown below 1.0360 level potentially exposes the next near-term support at 1.0330. Only a push-up and hourly close above 1.0450 will negate today's bearish bias to see a squeeze up towards the top part of this triangle range configuration. For the next near-term resistance to come in at 1.0490. Above it, retest the triangle range resistance level at 1.0530. So in a nutshell, because of this bullish divergence that's being seen on the hourly RSI, there could be potential minor bounce taking shape ahead or before ahead and maybe perhaps after the release of the US core CPI data, because this is a highly volatile event. As long as the bounce didn't surpass 1.04550 short-term pivotal resistance level, potentially another round of intraday bearish bias may resume on the euro dollar. All right, what's up next for the sterling dollar? So the sterling dollar doesn't have a clear bearish divergence or bullish divergence on the RSI, pardon me. The sterling dollar hourly RSI does not have a clear bullish divergence as compared to the hourly RSI of the euro dollar. So with that, we will continue to actually have a bearish bias on the sterling dollar, but I don't want to tighten my first short-term pivotal resistance to be so tight at 1.2615 level. So give a bit of breathing space at 1.2685. So as long as the bounce didn't surpass 1.2685, potentially the bearish bias next support level to watch will be at 1.2540 level, which is the 20-day moving average acting as a support level next. Okay, let me put it in better writing. 1.2540. A breakdown below 1.2540 exposes 1.2470 next, which is the 50-day moving average acting as a similar support level as well. Only a push up above 1.2685 will negate the bearish bias to see a retest of 1.2720. So 1.2720 is the upper limit of this potential bearish ascending wedge configuration that is forming on the sterling dollar. All right, so the 1.2470 also correspond close to the lower limit of this bearish ascending wedge formation as well. Only a breakout above 1.2470 will see an extension of the mean reversion rebound sequence, exposing the next near-term resistance level at 1.2780/1.2810. We saw confluence on the 200-day moving average of the sterling dollar. All right, so net overall still maintain that intraday bearish bias for a potential bounce first, as long as this bounce didn't surpass above 1.2685 short-term pivotal resistance level. All right, onwards next will be the Asia Pacific currency against the US dollar, starting with the Aussie dollar. So the Aussie dollar, like I mentioned, the daily chart, this 64 figure here is very key, which is the medium-term pivotal resistance. Why? Because it's the former major breakdown of the major ascending trend line or range configuration since the low of 13th of October 2023. And there was a retest of it on the key risk event as well, which is RBA first interest rate cut. Then thereafter it plummeted all the way down. So very likely the rebound all the way from the low of this 3rd of February all the way up to 21st of February. This is considered as a dead cat bounce or corrective rebound, and this corrective rebound is likely to have ended because of yesterday's clear bearish breakdown below the 20 and the 50-day moving average. Hourly daily RSI also shaping very strong bearish elements. Prior to this slide, there's a bearish histogram divergence, and yesterday it shaped a bearish crossover indicating the continuation of this medium-term downtrend phase of the Aussie dollar. All right, so in the short term, what are the key levels to watch on the intraday basis? So for the Aussie dollar on the intraday basis, we will tighten the key short-term pivotal resistance for today at 62.60, which is also the 50-day moving average. Bear in mind that the hourly RSI now is in grossly oversold level, hourly RSI. So potentially there could be sign of a bounce as well, either ahead or before the core PCE data release. As long as this bounce didn't surpass 62.60, we will maintain that intraday bearish bias. Next two near-term support level to watch. Thereafter will be 61.75 followed by 61.40. Only a breakout of an hourly close above 62.60 will invalidate today's intraday bearish bias to kickstart a minor mean reversion rebound sequence, retesting the 20-day moving average, acting as next near-term resistance level as well at the 63 figure level. Only a breakout above 63 figure level may shape a deeper intraday minor rebound sequence, exposing 63.55, which is also a Fibo retracement level if I take into account of this entire ongoing minor downtrend from the high that was formed on 21st of February that correspond to the 76.4% Fibo retracement at 63.55. All right, so net overall still maintain that intraday bearish bias as long as the minor potential bounce didn't surpass above the Titan key short-term pivotal resistance that we have for today at 62.60. All right, lastly will be the dollar yen. So the dollar yen once again can't break above the 149 50 60 level and starts to form a bearish Marubozu candlestick, hourly one, at the start of today's Asia session, this bearish Marubozu candlestick. And what we could see over here is that there's some form of hesitance by the bulls as well, but I don't want to use the 150.15. This is my first resistance as my short-term pivotal resistance level because of this ongoing potential risk event, which is the release of the core PCE price data. Thereafter, slightly higher at 156.70/95. So that was our second resistance level to watch yesterday for that minor corrective rebounds to take place. So potentially, this minor corrective bounce sequence may not be forming a zigzag, but it may start to form more like a flattish rectangle-like formation, given the fact that the hourly RSI has started to broke down below a parallel resistance level as well, and can't break above this horizontal parallel trend line over here. All right, that is in place since 18th of February. So with that, we will flip to a bearish bias on the dollar yen using 150.70/95, a bit of buffer given today's intraday, given today's highly volatile situation at the start and before during the first 2 hours of the US session. 150.70/95 short-term pivotal resistance, flip back to an intraday bearish bias. First support level to watch 148.80/70 that has managed to hold since 25th of February, which is this Tuesday. A breakdown below this level exposes 147.95 next. Only an hourly close and a push up above 150.95 invalidate today's intraday bearish bias to see another leg of minor mean reversion rebound sequence, targeting or the next near-term resistance level at 151.65, which will correspond to the downward sloping 20-day moving average as well. Right, so that's for the dollar yen, and also sum up the intraday technical outlook on the major major dollar pair. All right, so now let us focus our attention to the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 broke down below our Titan short-term pivotal support in today's start of today's Hong Kong session at 23,220, and also broke down below this minor steepened minor descending ascending channel support from the low of 3rd of February. So right now what we could see is potentially is shaping a potential minor mean reversion decline sequence to be traced back towards the rising 20-day moving average, and as well as the previous ascending trend line support from the low of 13th of January 2025. So first resistance level to watch for today will be 23,510, which is this breakdown level in today's Asia session, the gap down. But I don't want to put it as my short-term pivotal resistance level. Use it slightly higher. So this is a very clear pivotal resistance level tested since this Wednesday. Come break above 1 time, 2 time, 3 time, 4 time. All right, during the intraday session. So 23,830 short-term pivotal resistance level flip to a bearish bias for a potential minor mean reversion decline sequence to shape that retracement back towards the 20-day moving average, I think, as a support. First support level to watch 22,900/760, then thereafter followed by 22,470, followed by the key 22,130, which is the 20-day moving average. So any form of a bullish candlestick that's formed close to 22,130 may increase the odds of a continuation or the start of a new impulsive up movement on the Hong Kong 33 to resume its short-term and medium-term uptrend phase. All right. However, if suddenly we start to see a big bullish reversal up above 23,830, today's intraday bearish bias will invalidated to kickstart another bullish leg to expose the next near-term resistance level at 24,190/24,510. Right, so that's for the Hong Kong 33. Now onwards next will be the Japan 225 representing the Nikkei 225. So Nikkei 225, today it broke down below that multi-month major multi-month medium term or range configuration that was previously in place since late September 2024. So it's a major range configuration, medium term range configuration. So what I could see over here is that there's a bearish breakdown for today. So potentially we may start to see further price action decline on the Japan 225 after that bearish breakdown of the medium term range support. So using the medium term range support as a key pullback resistance for today, and that will be our 37,415. That will be our short-term pivotal resistance. So yesterday we have a neutrality stance. So right now very clearly there's a bearish breakdown, a range bearish breakdown. So we will flip to a bearish bias as long as any potential minor pullback. Given that the RSI now is at your oversold level, so there could be a chance of a minor bounce. So as long as this minor bounce didn't surpass clearly above 37,415 without any hourly close above it, we will flip to a intraday bearish bias for the Japan 225. Next near-term support level to watch will be 36,750, which is also the 1.236 Fibo extension level. And graphically, if you go back, it's the congestion area of 17th of September and 18th of September. Below 36,750 exposes the next support level at 36,450/220, which is the 1.382 Fibo extension as well. Right, only hourly close and a push up above 37,415 will invalidate today's intraday intraday bearish bias. I repeat again, only a breakout and an hourly close above 37,415 will invalidate today's intraday bearish bias to see a squeeze up for another choppy upward drift up back into the range triangle, the sideways range configuration again. Next near term resistance level to watch will be 37,800, followed by 38,490 that has been preventing the bulls from surpassing it since late February, since this week. So this week higher at 25th of February. All right, so that's for the Japan 225 flipping to a intraday bearish bias as long as the price action did surpass above 37,415 short-term pivotal resistance level. So onward next will be the German 30 representing the German DAX. So the German DAX also plummeted right now below the minor ascending trend line support level that I drew from the low of 3rd of February. So potentially we also may start to see a bit of mean reversion decline taking shape on the German 30. So using the pullback line over here of that former minor ascending channel support now turns into a pullback resistance. This will be our pivotal resistance for today, 22,440. So as long as 22,440 is not surpassed to the upside, potentially we may start to see another leg of minor decline sequence within its medium-term uptrend phase that is still intact because it's still holding above the 50-day moving average. First support level to watch will be 22,130, which is close to the 20-day moving average as well. A breakdown below it exposes the next near-term support level at 21,990/21,895. Only a push-up above an hourly close above 22,440 will invalidate today's intraday bearish bias and reinstate the bullish tone to revisit 22,680 and potentially above it sees the current all-time high area coming in at 22,930/23,050. All right, so because of the weak technical element that I explained to you guys on the hourly chart, there could be a risk of a mean reversion decline sequence unfolding for the German 30 within its medium-term uptrend phase that is still intact, using 22,440 as my short-term pivotal resistance for today for a potential intraday bearish bias. Now, onwards next will be the major US stock indices, starting with the US Wall Street 30 representing the Dow Jones Industrial Average. Still recall that over here is that yesterday we have this pivotal resistance level zone that has been stubbornly resisting the boost since this week. 43,730/84 tested a couple of times at the start of the US session and even in the middle part of the US session before it plummeted and hit our support level as expected at 43,120, 42,980. And this level over here is pretty key. Why? Because if you go to the daily time frame chart, it's in fact very close to the major ascending channel support that is been in place since 30th of October 2023. Okay, you could see this on the daily chart, and also very close to the in terms of the call it graphical level as well over here. This minor congestion area of 7th of Jan and 16th of Jan this year, and as well as so given the case that it's coming very close to a key support area, and the hourly RSI is also coming very close to the oversold region over here. So there could be some signs of a minor bounce taking shape into today's US session after yesterday's steep decline. So using 43,120 slash 42,980 as my short-term pivotal support level, we will flip to a intraday bullish bias for this minor corrective bounce to take shape. First resistance level to watch will be 43,380. Above it potentially sees 43,730 again. All right, over here, unless we start to see a very swift downward movement again and a breakdown for hourly close below 42,980, today's intraday bullish bias for that minor rebound scenario will be invalidated to see the continuation of the impulsive down move towards the next near-term support level at 42,690 slash 42,570 next. Okay, congestion area of 3rd of Jan and the 15th of Jan, and as well as the 2-time Fibo extension taken from this ongoing decline from the current high of 31st of January. All right, over here, which is also close to the current all-time high. So what I could see over here is that potentially, right, this could be a double top that is forming. Okay, and close to the double top neckline will be the 42,210, 41,775, which is close to the 200-day moving average. So price action may start to dwindle down towards this area here, all right, before any signs of a more pronounced bounce. But in the short term, intraday basis, because of yesterday's steep decline, there could be some form of a minor bounce taking shape first before another bearish leg resume on the US Wall Street 30. All right, so I'll be watching very closely 43,120 slash 42,980 short-term pivotal support I have for today for this potential minor bounce to play out. Okay, onwards next will be the Nasdaq 100. Okay, before I touch on the Nasdaq 100, I want to share with you the medium-term technical element, which is on the daily chart. So the pivotal resistance level was the MT pivotal resistance at 22,470, 980. Price action reacted off it, and also this is the upper boundary of this channel in turquoise blue, which is the long-term ascending channel from March 2020 low, the pandemic low. And what I could see over here is that yesterday's price action has a clear daily close below this key support level at 20,790. Previously managed to hold, survive since 13th of January, also managed to survive since 27th of January, and this 27th of January's sell-off was due to the emergence of the cutting-edge Chinese DeepSeek, we call it public awareness that this particular Chinese AI large AI reasoning AI LLM model is able to run at a lower cost compared to its rival US-based OpenAI. But nevertheless, from a technical perspective, it seems to us that ongoing forward, there could be a start of a multi-week decline for the Nasdaq 100. Next support level to watch will be 19,840. Below it sees 18,310, which is the median line of this long-term ascending channel that I draw in this dotted green line here that managed to survive previously on the 19th of April last year, and as well as 5th of August that yen induced, but that yen crosses sell off on that particular situation month in August. So net overall, right, this is a daily chart. So whatever price action that I shared with you earlier could unfold in a longer time frame. So on an intraday period over here, price actually oscillate within a shorter time frame. So there could be bounces here and there. So if you look at the hourly chart, which is more of our daily dose of insights that we are more concerned on, because we look at it on the intraday basis, the 1 hour RSI is for sure is in the oversold region as well. And now we could see a bullish divergence that has been formed. Okay, there's a bullish divergence that has formed, and price action now is coming very close to the 0.764 Fibo extension, which is the fifth wave target on the downside. That means this could be a wave one, a minor wave one. Let me put it in writing. Okay, a minor wave 1, a minor wave 2, a minor wave 3, a minor wave 4 over here, and a minor wave 5. All right, so 1, 2, 3, 4, 5 with a fifth wave target at 20,335, corresponding to mathematical indicator 200-day moving average. Also, coincidentally, we start to see the RSI at the oversold region, and we flash out a bullish divergence right now. So indicating that this 1, 2, 3, 4, 5 sequence likely to have ended. So in terms of an elliott wave perspective, every fifth wave end, there could be a retracement of that fifth wave, either on the upside or the downside. So what it means that over here is that there could be a high chance of a intraday mean reversion rebound taken shape to actually retrace the the end of a fifth wave down cycle from an elliott wave perspective, taking into conjunction where the price action is resting on key technical elements. So with that, for today, I will flip to a intraday bullish bias using 20,335 as my short-term pivotal support level for the Nasdaq 100. First support level resistance to watch for this potential mean reversion rebound will be this zone here at 20,910 slash 20,790. Only a breakout above it potentially sees it inching higher to 21,030. But however, if price action don't dictate accordingly to the elliott wave we call it application, and starts to plummet downwards towards 20,355 hourly close below it, then this impulsive up move, then this mean reversion rebound scenario will be invalidated to see the continuation of the impulsive down move, exposing the next near-term support level at 20,140, 20,070, followed by 19,910, 19,840, which is the minor swing low area of 31st of August and 4th of November. So net overall, despite the fact that yes, we may see a mean reversion rebound taking shape, but this mean reversion rebound shouldn't be transformed into a potential medium-term bullish reversal yet. So i.e. the chances for it to see fresh new all-time high will be slim right now on the Nasdaq 100, given the higher time frame daily chart that I've flashed for you guys is that they are more supporting of a multi-week corrective decline. So until this multi-week corrective decline sequence plays out, then we will start to see the start of a potential new impulsive up move sequence on the Nasdaq 100. So with that, that sum up the intraday technical outlook on the major stock indices as well. So now let us turn our focus now towards the commodities market, starting with this Gold XAU/USD. So for Gold XAU/USD, yesterday we flipped to a intraday bearish bias for Gold XAU/USD, and indeed the price action actually break below the 20-day moving average over here, which is 2,880, and starts to plummet much lower at this point in time. So with that, what we could see over here is that the hourly RSI now, there's no bullish divergence yet. So what I could do over here is that I will actually use the 20-day moving average over here as my short-term pivotal resistance level, and also this dotted line here, which is the ascending trend, former ascending trend line support from the low of 31st of December, a medium-term one, because it's more than a month. So let me tighten it for today. Okay, so this will be my tighten short-term pivotal support for pivotal resistance for today, 2,893. Okay, so okay, then this one here will be the next resistance level to watch. Okay, 2,893 tighten short-term pivotal resistance level, and also correspond to the upper limit of this ongoing minor descending channel that I drew from the high of 25th of February. Next support level, maintain the intraday bearish bias for this potential corrective decline sequence to play out for Gold XAU/USD. First support level to watch for today, 2,845. A breakdown below it exposes 2,810, which is this minor swing low area of 4th of February. And like I say, potentially this minor corrective decline sequence may not have ended, because we have still some more room to go before hitting the 50-day moving average, I think, as a support level at around 2,765 next. But on the intraday basis, this should be sufficient for the near-term support level to watch, 2,845 followed by 2,810, unless we start to see a push up and and the breakout with hourly close above 2,893. Today's intraday bearish bias will be invalidated to see a minor bounce to retest 2,923. Above it, we may see a test on the current all-time high area at 2,954. So i.e. still maintaining that intraday bearish bias for gold XAU/USD, but use a tightened short-term pivotal resistance for today at 2,893. All right, so lastly, next will be the West Texas crude oil. So West Texas crude oil managed to stage a bounce over here and broke above the short-term pivotal resistance that we have yesterday at 70.40. So right now, what we'll see over here is that there could be a kind of a magnetic retest towards the 20-day moving average acting as a resistance, and also the minor swing high area of 25th of February at 71.35/70. Now the RSI has just exit from the overbought region. There's no bearish divergence about this prior to this exit, so potentially there could be still another leg of bounce, retesting 71.35/70. So with that, I'll be using this former congestion area here now turns into a minor pullback support area, which is my short-term pivotal support level at 69.50. So as long as this minor decline, while the RSI starts to exit from has already exited from the overbought level, as long as this minor slight didn't surpass below 69.50 short-term pivotal support level for today, I will flip to an intraday bullish bias for this corrective rebound phase to play out on West Texas crude oil, for it to revisit 71.35/70, which also correspond to the downward 20-day moving average. However, if price action starts to break down below 69.50, then the impulsive down move sequence will resume for West Texas crude oil, revisiting 68.80. A break below it exposes 67.96 next, which is the minor swing low of 10th of December. All right, so that sum up the intraday technical outlook on the broad-based cross asset classes. So before we go, as usual, let's have a quick look at the economic calendar. So other than the US core CPI, core PCE data that are going to be released later in the start of the US session, what other European data to take note of for today will be more pertaining to the Eurozone, the key anchor of the one of the key anchor of the Eurozone economy, Germany. So Germany will report its retail sales at 3 p.m. Singapore time that may impact the German DAX and as well as the euro dollar. And we also have preliminary inflation rate coming out from another Eurozone anchor economy, France, will be at 3:45 p.m. Singapore time, then followed by 4:55 p.m. Singapore time, which is the German preliminary inflation data as well. All right, inflation data. Yeah, this is the one, the 9 p.m. Sorry, 9 p.m. Okay, now harmonized inflation rate 9 p.m. Singapore time. And thereafter, at 9:30 p.m., we have Canada Q4 GDP number, preliminary one, that will be released, so that could impact the dollar CAD and potentially some of the CAD crosses. And this is the key data that most market participants are watching out for today, will be the 9:30 p.m. release of the core PCE price index, because this core PCE data is the more closely watched inflationary trend gauge in the US by US Federal Reserve officials. So the core PCE price index year on year, market is expecting a slight dip to 2.6% from the previous month of 2.8%. So let's say if it's within market expectation, there shouldn't be any big surprises for the dollar may continue to resume its uptrend, unless it starts to go down very, very low at 2.4 or 2.5%. So if you look at the trend of the core PCE index, is rather stickier. So unless it's able to dip down to 2.4%, then we could see a potential intraday dollar sell-off after yesterday's rise. All right, so it's been stable since November over here. So the previously was 2.7%. So if we dip down to 2.4 or 2.5%, that could see a deceleration of inflationary trend in the last 5 years. But however, if it starts to tick up to above 2.8, then potentially we will start to see a stronger US dollar coming into play, and that could also impact the further potential weakness on the major US stock indices. All right, so with that, let me have a quick look at the calendar first. There shouldn't be any much more data, okay, except for Saturday. This could impact the movement on early Asia session on Monday, where we start to see the key government compile, China government statistical board compile, manufacturing PMI and non-manufacturing PMI for February. So that could potentially impact the China's proxy stock market, which is the Hang Seng indices, on the early Asia session next Monday. All right, so with that, that is 9:30 a.m. On Saturday. All right, so with that, that sum up today's daily dose of market insight. I wish you a great weekend ahead. Do have a restful rest over the weekend and enjoy the weekend as well. And another highlight on the highlight is that from starting from next Monday, so next Monday daily dose will resume back to its normal time. So we will kickstart at 11 a.m. next Monday instead of 1 p.m. So I repeat, from next Monday, daily dose onwards, that means i.e. a brand new month of 3rd of March, we will kickstart our daily dose at our usual timing at 11 a.m. So with that, we shall speak again and on next Monday, 3rd March, 11 a.m. So see you guys. Thank you.